Have you ever wondered how to grow your money while minimizing risks? In the intricate dance of finance, mastering the art of portfolio investment often plays a pivotal role. Imagine diving into a pool filled with various floating treasures, each representing a different type of asset. Some are closer to the surface, easy to grab, representing stocks. Others, like bonds, might require a bit deeper dive, but they're just as crucial. Then there are mutual funds, a combination of treasures managed by someone who knows exactly where the best gems are hidden. Starting with stocks, think of them as pieces of a company. Buying a stock means owning a slice of that company. If the company does well, so do you. If it falters, your investment might decrease in value. Stocks are known for their potential high returns, but remember, they also carry a higher risk due to market volatility. Now, let's swim over to bonds. Bonds are essentially loans that you give to corporations or governments in exchange for periodic interest payments, plus the return of the bond's face value when it matures. The safety net here is that bonds generally offer lower returns than stocks, but are considered safer due to the steady income they generate. Cruising through our financial pool, we encounter mutual funds. These are professionally managed investment programs funded by shareholders that trade in diversified holdings. A mutual fund can be viewed as a basket of various types of investments: stocks, bonds, and other assets managed by professionals who aim to maximize returns and minimize risks. Each type of investment carries its own set of risks and rewards. Stocks, while potentially lucrative, face market risks and volatility. Bonds, on the other hand, are vulnerable to interest rate risks and inflation. Mutual funds combine these risks and rewards, offering a diversified portfolio in itself. But why put your eggs in different baskets? Diversification is key. It's about not just owning different investments, but owning investments that behave differently. This strategy helps in reducing the risk of losing money and can lead to higher returns over time. Moreover, most portfolio investments provide liquidity, meaning you can quickly convert them into cash. They also allow for professional management, where expert hands guide the growth of your investment, making them an appealing choice for many. In summary, diving into portfolio investments involves exploring stocks, bonds, and mutual funds. Each offers unique opportunities and risks, but when combined, they create a robust portfolio that can weather different financial climates, achieve higher returns, and maintain liquidity. Understanding these elements allows investors to navigate the waters of finance with more confidence and clarity. Remember, the goal of portfolio investment is not just about achieving higher returns, but also about managing risks through a diversified approach. So, next time you think about your financial future, consider how a well-balanced portfolio might be the key to achieving your investment goals.